calendars will have a little bit less favorable theta decay, but it also has a much lower risk. With iron condors, your maximum loss is actually close to the same as your maximum profit. So, but it also is limited. It's extremely limited. So in this case, we have a $45 of potential profit. Maximum loss is $55. And it doesn't matter how high this particular position goes. I mean, prices could go into the stratosphere. We'd still have a maximum losses of only $55 on this position. So it's, you know, iron condors can be very, very safe to put on. But in order to achieve a maximum profit, you really need to understand the art of adjustments. And that's what really this course is all about, because adjustments are, in fact, one of the ways that not only we defend positions and protect positions, but also because of the way that we can rescue positions from being unprofitable to being profitable. So this is the iron condor. What is the difference between an iron condor and a calendar? Well, a calendar, instead of all of your positions in the same month, a calendar is just what the name says, is actually what you're doing is you're selling a option in 1 month, and instead of buying an option in the same month to protect it, you're buying an option in a different month to protect the sale of that option. Let's take a look and see exactly what that means. Let's go back to our trade tab, and we're going to delete this out. And if we go back into our trade tab here, we will take, let's take a look at this for a second. Let's go back to extrinsic value. We're going to take that. See, whenever you change these, it will bring up different bits of data for you to analyze here. There's lots of different things that you can analyze here. Bid size, ask size, open interest on an option, it's delta, it's gamma, it's theta. I mean, if we were to determine the theta of these different positions, you can see that the most theta is derived from those options right around the in the money. As we get farther and farther out, the theta decreases the farther we go out. In the last example, we were going to be selling the 142 call. It had a theta of 4 cents. We were buying the 143 to protect it, so that if you subtract those two, we had a 1 cent theta on that one, and the same, we probably had pretty close to the same theta on the downside here. Let's see what we're doing. I think we were doing this one here, the 132 puts. We had a 5 cent theta on that one and a 4 cent theta on the one we were buying. So it came up to about a 1.3 theta, 1.3 cent theta that we were achieving on that position. But theta is strongest at right around the in the money options. That's where you achieve the majority of your theta. But it also has a very low probability of being successful. All right. Anyway, we can change. There's a lot of different variables and information that we can receive from this position. Right now, what we want to do is we want to take a look at the extrinsic value. This is the actual amount of time value left in these options. We're going to do a very simple calendar. Remember, all the positions that we put on are based around the basic concept of vertical spreads. The vertical spread I showed you already. You're buying one option, you're selling another. In this case, what we're going to be doing is, in order to create an opportunity in which we achieve our goal of increasing theta, we are going to be selling an option that is at the money. Why would we do that? Because we want the most extrinsic value as possible. In this case, we have $2.61 of extrinsic value at the 138 strike price on the call side. We want to sell one of those to capture that $2.59 in credit. And what happens is when you do enter an order like this, you don't actually buy this option. What you do is you use margin. In other words, the brokerage company determines what your risk is in this position if you were to sell this one option. And they would margin your account accordingly. They would eliminate that amount of money from your account so that you can't spend it just in case this position goes against you and you need to have the available cash to buy this option back. The further this gets away from you and the more money you lose on this position, the more money they're going to take from your account and leave it in and not make it available to you for further purchases of calls or puts. And remember, the sale of a option is called naked selling of an option, and it's extremely risky. So we don't do it. However, we do like to protect our positions. We do like to sell options, of course, but we don't like to do it naked or with unlimited risk.